Hey climbers, welcome back to Climb by VSC, a weekly show about building and scaling startups in the world of climate innovation. My name is Jake Kapoor, general partner of VSC Ventures and co-host of Climb. Every week, I or a member of our VSC team will speak with a pioneer in the climate tech world about emerging technologies and novel ideas that will turn the tide on climate change. We've all heard enough of the doom and gloom. It's time for stories of purpose-driven innovation that lead to sustainable, positive change. As always, I'm so happy that you've decided to join us. Now let's climb. Hey everyone, welcome back to another episode of Climb by VSC. I am so thrilled to have on Tommy Stadlen, who is the founding partner of Giant Ventures, a global venture capital firm backing purpose-driven founders solving the world's biggest challenges. Sounds a lot like what we do here at VSC Ventures, Tommy, so I'm excited to meet a kindred spirit. Before starting this, Tommy was the co-founder of Swing, a consumer technology company that was chaired by Twitter founders Biz Stone. Swing later sold to Microsoft, where Tommy held some product leadership roles. In addition to his role at Giant, he's also the chairman and co-founder of Tailwind Group, which has launched 3 public companies with a combined market cap of over $1 billion. So, our conversation is going to range both early stage investing, growth stage investing, and also where we see some of the exit opportunities for the amazing climate companies that we're backing today. But I'll just start by saying, Tommy, thank you so much for joining me on Climb.
Thanks so much for having me. Yeah, I'm a big fan of the show and everything that you're doing with your fund, and it's such a pleasure to be with you today. So thanks for having me.
Well, that's wonderful. We got a lot to cover today, but before we do that, just so our listeners know a little bit of your background and who they're hearing from today, tell me about how your journey led you to co-founding Giant Ventures and where this passion for backing purpose-driven technology founders really comes from.
Absolutely. Well, I've been doing climate for about 15 years now, which feels like a long time. At the beginning, it felt a little bit lonely sometimes, where it was not the topic of interest that it has become today. So really, the first half of my career was around climate and sustainability, initially actually in the policy world. So I started off working on policy for then Senator Obama on his campaign to be president, and worked also briefly for David Miliband, who was the UK Environment Secretary and then the UK Foreign Secretary. It's actually the first to write into law legally binding emissions targets over in the UK many, many years ago before others had done that. So I worked a little bit in policy, then did a similar role in the commercial world, working at McKinsey, helping corporates figure out their climate strategies and how do they start to invest behind climate change in a way that is compelling from a returns point of view. So I'd done quite a lot in climate policy and climate strategy, looking at the corporate world. I then wrote a book about it called Connect, How Companies Succeed by Engaging Radically with Society. And I wrote that book with a mentor of mine, Lord Browne, John Browne, the former BP CEO, who had led BP famously beyond petroleum and had tried to begin their journey into solar and other renewable asset classes. And then John had become a very large renewable energy investor at Riverstone and later General Atlantic. So we teamed up on a book trying to explore basically how companies could put purpose at the heart of their business model, rather than seeing climate and other social issues as a kind of disconnected corporate social responsibility issue that is almost the Friday afternoon club that you get to at the end of the week once the core business has been dealt with. And that was an amazing experience writing that book. And we interviewed 80 CEOs from all around the world, and came out with a thesis, which we felt was compelling, which was there is a serious competitive advantage to be had by going deeply after issues like climate change and really trying to put your whole business model behind it. We thought it made sense. But ultimately, when we went and told this story, the book did well. It was a bestseller. But ultimately, I felt particularly with CEOs, the eyes kind of glazed over and intellectually they understood the argument, but they weren't quite ready. It still felt very, very early. And I was left feeling that it was not going to be companies who are very, very large, the big corporates who are going to solve climate change. It's going to be startups whose name we don't even know yet, whose sole purpose from day one is going to solve the climate challenge and other big social issues like healthcare and others. So that was my sort of conclusion from that period of my career. I then went and did something completely different. I moved from London, where I was born, to California to start a startup. And you mentioned Swing, which was my startup. Did that with a friend from London and Biz Stone of Twitter. We had an amazing ride doing that and ended up selling it to Microsoft. And once I'd done that and then became an investor, I really wanted to bring together those two strands of my career. So on the one hand, climate and sustainability and making the world a better place. And on the other hand, technology, entrepreneurship and innovation. And that's where Giant came in. And I teamed up with a very old friend of mine, Cameron McLean, and we wanted to build a firm which basically was helping back the best, the brightest entrepreneurs who are mission driven, whose sole purpose is to go solve the big global challenges of the day, and support them in a compelling way to go and build these great companies. And that's what Giant does.
Yeah, I love that. I love the sort of mission statement there, but then also bringing, I think, a decade plus of experience where you've seen sort of the clean tech 1.0 and the kind of after bursts of that. And, you know, one of the most interesting things of doing the show is I think I had a very different view of what clean tech 1.0 was until I started speaking to some of the folks that had seen it and actually said, you know, there have been a lot of great after effects that are spurring the innovation we're seeing today. So the folks that call it a failure are maybe sort of missing the forest for the trees. But I want to click on something you just said there, Tommy, which is that the incumbents are not going to be the ones that are driving this change forward. So help me maybe understand, you know, you've said that climate innovation is going to be the biggest investment opportunity. We have these incumbents who potentially would have real economic benefits for going after it. Where's the disconnect? Why are the startups going to be the ones that benefit from this?
I think it's just extremely hard if you're running a very large corporation to sort of turn the ship around from what you're currently doing. And so, you know, if you're a supermarket chain, you know, if you're a sort of steel company, it's just very, very hard to fundamentally shift what your direction of travel is and go after something else. And so I think inevitably issues like climate and other ESG issues do tend to be disconnected from the core purpose and strategy of the business. And that leads to greenwashing. It leads to, as I said, sort of CSR being this disconnected issue run by public affairs teams or CSR teams who don't really have anything to do with the core operations of the business. And I think it is just so much easier if you're starting from a blank sheet of paper, day one, you know, we are going to roll out heat pumps across Europe, or we are going to go build a green steel plant in the US. And so I think it's just a clarity of purpose from the beginning is so much easier to do from a standing start. What I would say, though, is that we are very big believers that the startups we're backing and you're backing in climate technology, if they don't partner with the incumbents and if they don't help to change the incumbents, whether it's government or corporate, we're not going to get near decarbonizing the economy. So a big part of what we try to do at Giant is taking these early stage climate technology companies and help them sell into the big corporations so that they can help those corporations go on that journey. Or helping corporations who are really struggling to go anywhere near decarbonization through things like carbon marketplaces. So there are so many ways that we can help these big corporates do it. But I think startups have to be part of the solution because the corporates are simply not going to get there on their own.
Yeah. I guess thinking about, you know, the amount of attention that has been on climate tech broadly, the capital that has followed with it, we're now talking in August 2023, and the most recent data suggests that Series B rounds are down something 20, 25%. Series C rounds are down almost 70% in climate specifically, to say nothing of the sort of broader tech ecosystem. And then yet, you know, everything that you're sharing is there's industrial tailwinds, there's regulatory tailwinds. So for founders that are listening and they're thinking about fundraising, you know, maybe paint the picture a little bit. What's happening in the startup capital markets to kind of square the circle? This is a massive opportunity, and yet there's capital constraints as you get sort of higher up the growth stage stack.
Yeah, it's a really good question. I think if you step back, if we get anywhere close to decarbonizing the economy in the US and Europe by 2050, climate tech is going to be the single biggest economic event in human history. It's going to be orders of magnitude bigger than the internet, both in terms of the winners that it creates, but also in terms of the losers, the folks who are exposed to stranded assets like oil and gas and coal. So if you just do the maths, it's roughly $10 trillion a year of investment that's required to get to net zero. And I don't know about you, but I certainly believe that we're on a political path where that is becoming more and more certain. In Europe and also in the US, you know, it's been amazing to see the kind of bipartisan support for the IRA, for example, that I was amazed by, that has clearly pushed that through. And I think that is because partly citizens in the US and Europe have seen climate change physically come to their door in the last 2 or 3 years. So we are getting there politically, which means that the economic opportunity will be there. Why is that not trickling down at extreme pace, as you say, right now in 2023 with the venture markets? I think everyone is still trying to figure out how to avoid the mistakes of the first clean tech boom and bust, which you mentioned. And I think LPs in a world where There's the denominator effect. They're probably overexposed to venture overall. They've just had a very, very difficult time with the technology boom coming to a bit of an end over the last couple of years. So everyone's sitting back and going, okay, we know climate is this huge opportunity, but we also have probably been burnt from the first clean tech boom and bust. How is this going to play out? How is it going to be different? And I would make a few observations. I would say we are seeing a few different mistakes. On the one hand, we're seeing, I think, venture investors trying to deploy venture dollars into infrastructure investments, into fundamentally non-scalable, very capital-intensive projects, which I don't think call for venture capital. So some of the bigger energy projects, things which might take 15, 20 years, a lot of science risk and a lot of capital intensity, and that's pretty tough. And then on the other end of the spectrum, we're seeing, and I'm sure you see this, some of the generalist VCs who want to have exposure to climate, but only want to touch pure software. And that creates these strange bubbles around things like carbon accounting, where we get pitched a carbon accounting startup literally every week. I'm sure it's the same for you, because that's sort of one flavor of climate, which is appealing to the more traditional venture firms. And that creates strange bubbles and some mistakes. And so I think you have to kind of navigate that path to what is actually going to have an impact on climate, because it is in some way touching the real world, but it is actually a venture-backable, scalable business. And that's the path that everyone's trying to navigate. And I think there's almost a kind of wait and see, both from LPs and from some of the GPs, the venture firms, to figure out where they should be deploying money in climate. Because yes, it's a huge opportunity, but you've got to be really careful about how you access that opportunity.
Yeah, I'm really glad you said the piece about pattern matching, right, on the software side, because VCs for so long we've come out of this last decade of the SaaS boom. And I think VCs are trying to apply a lot of those same lessons to now climate investing. But one of the best pieces of advice, or I guess even quotes, that one of my founders, a company called Revel here in New York, said to me, they're in the transportation world, they're in the electrification of the local New York City grid. And he said, Jay, you can't move fast and break things in this world, because the things you're breaking are people. And it sort of has stuck with me that, unfortunately, a lot of the lessons that you have in software where, hey, you mess something up, okay, a deployment goes the wrong way. When you're dealing in the world of atoms, not bits, the order of complexity is so much higher. And I guess that sort of dovetails into a lot of your experience on the government side. Tommy, a lot of VCs for many, many years have sort of stayed away from anything that has to deal with government. Unless that is your fund's very specific thesis, government is a 4-letter word. And now we're in this world where government needs to be, hand in hand with industry, hand in hand with startups. So what are some ways that you think, both on the startup side, startups can do better to engage government? And then on the flip side, what's the role of government in empowering kind of this wave of innovation?
Well, I always think it's a good idea not to bet against the Fed. And the Fed is pouring, tens of billions, trillions of dollars ultimately into climate tech. And I think that is on a path which can't be reversed. Whatever happens with the US election cycle, I do think we're now on a path where the US government has got behind this in such a phenomenal way that it's going to be very difficult to bet against that. But this question of the role of government, I agree, I think is fascinating. The myth, the received wisdom is that, as you say, don't invest in stuff which requires government support. All of the subsidies, fundamentally reveal a lack of a sustainable business model. And also that government can't innovate, I think, is another myth. There's a fantastic book I would recommend by Mariana Mazzucato, who's a UK-based Italian professor, called The Entrepreneurial State. And her thesis is that actually, if you look at the history of innovation in the 20th century, so many of the most important technological developments, whether it's the internet, the mobile phone, and others, have ultimately had their origins in government, whether it's in the US Department of Defense or others. And actually the government is really, really important for innovation, both in terms of R&D within its government departments and in terms of funding. And in Europe, if you just look at where the LP money comes from, for example, so much of European venture is propped up by the European Union funds and by individual sovereign wealth funds. And I think for issues clearly like climate, but also like health, the government has a massive, massive role to play as a funder, as an R&D department, and also as a first customer. And so we're going to see more and more in climate, I think, of governments having to fund and be the first customer in order to get these industries off the ground, and so that they then can prosper and stand on their own 2 feet.
Yeah, it's quite a non-consensus even in today's market viewpoint, right? To your point earlier about kind of these these waves of companies, right? We talked about carbon accounting software, carbon credit marketplaces, climate insurance. There's a lot of monkey see, monkey do, right? You'll see one get funded, and then suddenly there's a wave of 3 or 4 competitors that come through. As you're building your fund, how do you structure your process to kind of reject that groupthink, to push yourself to look at non-consensus things versus getting kind of caught up in the FOMO of it all?
We looked at some analysis from some of the best performing funds and spoke to some of the general partners at some of those funds. And consistently what we heard was that it was the contrarian investments, the non-consensus investments that had performed the best. So the deals that made it through IC with 100% of the partners voting yes didn't tend to be that good. Clearly the ones that everyone said no to were not good and didn't get done anyway. And it was the ones which were, really divisive, where you had one champion perhaps saying, we've got to do this deal, and then a bunch of other people perhaps saying no. Those were the ones that really outperformed. And we're very, very conscious of that. It's probably not thinking outside the box that much. And it's probably going to be quite a competitive landscape if it's such an obviously good idea. So we are conscious of that. We've tried to put in place some structural components that allow us to do non-consensus contrarian investment. So for example, the partners at Giant all have a wildcard investment that they can make. So even if the other partners strongly disagree with doing an investment, we each have one per year that we can push through and say, no, I'm doing this anyway. And actually some of our early winners in the portfolio have been companies that not only internally at Giant, it didn't have full support to do, but we were the only term sheet externally. No one else was interested at seed. And if those go well, they tend to perform really, really well because the valuations are not very high when you invest. I think that is really important. You mentioned, again, their carbon accounting. We went really deep on carbon accounting in sort of early 2020 and were looking at the space. We were looking at Watershed, the carbon accounting software platform. That one, actually, we were really keen to do. We chased the founders and we ended up learning that it was the first deal, I think, that John Durr from Kleiner and Mike Moritz from Sequoia had done together since Google. So we were okay that we lost that one. But beyond that, we haven't done anything in carbon accounting. And why? We felt that already there was so many competitive dynamics in that market where we would speak to customers of these types of companies and they would say, it's great. We put out a request for proposal and we'll get 15 to 20 startups who'll come back and bid on it. The price gets bid down and down and down. And then, ultimately we might even pick a PwC or a McKinsey, or we thought SAP might get involved. So very competitive from startups, incumbents and consulting firms increasingly playing in the space, and just a very negative margin compression that we saw coming. So we decided not to play in that space, but instead made an investment in a company called Waterplan, which is an adjacent space, which is rather than carbon accounting, it's around water risk. So for companies like Coca-Cola or Amazon, who have a lot of water in their core business model, helping them manage and mitigate their water risk, much less competitive. So that's a sort of example of us going deep on a sector which was quite hot and then choosing not to invest, but investing in an adjacent space. Maybe
help me understand what signals of traction you need to see, let's call it at early stage, right? What makes an early stage investment good for Tommy, and one that you really want to sort of chase and get after when you see those signals?
I think there's a kind of meme going around at the moment about pre-seed investors saying to founders, sorry, it's just too early for us, and how that should be banned from seed funds, giving that as an excuse to founders. We love investing early. We love being the first money in, let alone the first institutional money in. The earlier, the better from our point of view. And really, whether it's pre-seed or seed, I don't know about you, but fundamentally, I think really it's all about teams and founders that you're backing at that stage. The idea changes so much, as you will have experienced yourself. And so I am very much a people-based investor. I want to back entrepreneurs who are incredibly smart, really resilient, and have perseverance, and are talent magnets. They can attract people, brilliant people, to come work alongside them. And then if they're working in a theme that Giant can get behind, particularly climate or health or inclusive capitalism, then I think it becomes, a no-brainer. Because I don't think at seed, as opposed to pre-seed or even Series A, I don't think actually most of these companies are de-risked that much. So I don't think you're getting that much benefit coming in a little bit later, 6 months to 12 months later, compared to just going in early and backing the team from the beginning.
No, in fact, you're probably losing out on valuation, because they'll say, well, we've already raised the seed round. Functionally, we can't raise anything sub, 20 million now. And you're going, well, I don't know if you've had the traction to effectively go raise that next round. But, we're coming out of a market in 2021 where if you were the right background and in a hot space, it almost didn't matter.
I think that's exactly right. And I think exactly those dynamics are harming founders quite a lot, actually. And raising too much too early makes it then very difficult to get the next round done.
So you said three things. You said when you're looking at a founder, it's smart, resilient, and talent magnets. How do you ascertain that? Are there questions that you're asking them?
Yeah, well, so smart should be a straightforward one to figure out, I think. And that's almost sort of table stakes. And actually, I don't know about you, but our experience has been, it's not necessarily the brightest, most intellectually brilliant founders that always build the biggest companies. You've got to have some base level of intelligence, obviously, and most of these founders are really smart, but it's not necessarily, you've got to be a complete genius. The second thing there around perseverance, I personally think that is the single quality that unites all of the most successful founders unless they got lucky. I think it is so hard building startups. It is so unbearably difficult. The odds are against you. The existential threats that come in every single morning. I remember when I was doing a startup based in California, but with sort of customers in New York and investors in London, you'd wake up at 8 a.m. or whatever in California, and you'd already had a bunch of existential threats hit your inbox from New York and London by the time you woke up. And it was just very, very mentally hard. And so I think it's folks who can persevere, who can run through brick walls, who just simply refuse to give up, that will make it. And then talent magnet, I often ask myself, which is I learned from an investor I used to work with, would I go and work for this person? Would I go work for them today? Or as a sort of 25-year-old, would I go and work for them? And that's always a pretty good test that unless you feel like, yeah, this is someone I would go and follow, probably not the right type of person to invest in. So those are some of the kind of themes that tend to come out. But perseverance above all else for me, I think.
Yeah, I agree on all of those, and especially perseverance. I think, the way we try to ascertain it is we ask our founders, what is the scrappiest thing they've done to date, right? And sort of what's the hardest challenge they've had to date. And it's not so much the actual the challenge itself. It's how did you find your way out of the hole? How did you find your way out of that dark corner? That actually, I think, reveals a lot about a person. One thing we didn't talk about is customer obsession, but you mentioned it earlier, right? Actually going and speaking to customers and evaluating the customer need and problem. How are you guys doing that at your firm? Are you actually calling up prospective customers and doing a little bit of BD yourself? Or is it something you're evaluating with the founders process that sort of shows you this is not a technology in search of a problem, this is actually solving a real customer need?
I think that is so important, isn't it? And I think where I've made mistakes in the past is probably backing founders who don't have enough customer obsession and probably are living in a bit of an ivory tower and don't have the obsession about, I will tweak product in whatever way I need to do in order to meet the needs of very specific early customers. And so I think it's always a bit of a red flag when you're hearing from a founder that they haven't spoken to that many potential customers, or, they're going to build a product for a year and then launch it. I did that with my startup. I kind of locked our team away and myself away for like a year, built what I thought was the perfect product, had a massive kind of big launch and then hoped it would just work. And then actually it turned out people didn't really want it. And then we had to kind of urgently scrap to change the product. But that's not the way to do it for sure. It was really interesting listening to Sam Altman speak the other day around OpenAI and how, he'd always been preaching the Y Combinator code of, just ship stuff quickly at low cost, get it out in the market quickly. And he always believed that. And then OpenAI probably disproved that in that they did sit there for years and years before launching, building the most amazing, perfect product. They raised billions of dollars to go and do it. And so they're almost the opposite to that. But I think OpenAI is one of very few companies which has succeeded without just being obsessed with customers, constantly launching as early as possible. And part of that, I think, is an obsession with customers for sure. And just speaking to customers, it's as simple as constantly be speaking to your customers.
Yeah, I think the operational complexity in climate, I think, maps quite well to the OpenAI example there as well, right? There's only so many launches you get, especially when you're maybe building in the world of hardware. So talking about repeat founders, since we're on the topic, Tommy, you wrote this fantastic piece in Fast Company that I really enjoyed about repeat startup entrepreneurship. And the quote that I sort of held onto was, it turns out experience really helps in starting companies. What are 2 or 3 things that the repeat founders are doing differently that first-time founders can start doing today?
Yeah, it's a really good question, that one. Look, I mean, I think part of it is not necessarily about what they're doing differently. It's just the benefits they accrue of having done it once. So they tend to have really good networks. They've probably figured out this is the right lawyer to use. They've probably figured out these investors have my back and these ones are awful and I'm never going to work with them again. They've probably figured out a team that they can go back to and say, look, let's go build this again. So just having that network can, I think, be very, very useful and save a lot of time. I think the second thing is just avoiding unforced errors. I for sure, in my startup days, just made so many stupid errors that I would never make if I had a second chance to do it. So those are some of the really obvious ones.
Is there anything that you feel like the second time founders like focus on earlier, that you feel like it just takes first time founders so much longer to get there?
I think part of it is just focusing on the right things. So I think, for example, not locking yourself away and your team away and just sort of building the perfect product and then not launching. I think people launch quicker. They're more willing just to kind of test stuff out and quickly learn. I think that's one big one. I do think picking the right partners, picking the right team, people figure that out. They understand just how important that is. So those are some of the elements of it. But ultimately, I think just having done it and having learned and got the scars from being through it once, you just learn a lot. The other thing that I would say is that from my own personal point of view, I wish I'd been even a venture investor for 6 months or a year before I started a company. I do think investors learn a huge amount by being operators. And I think operators learn a huge amount, if they had, of having had some venture experience, really because of the kind of pattern recognition and sort of having the privilege of seeing thousands of companies in a year. I think you can then avoid some of the mistakes. So for example, I started a photo app in like 2014 when there already existed Instagram and sort of Snapchat was coming up. And that was probably a really stupid idea, right? And if I'd been a venture investor, I would have gone, really bad idea, too late, I'm way too late to this problem, but kind of naively just walked into it. And so I think there is an element of if you can have some of that venture experience before starting a company, I think that's personally a great idea, as well as having had as much entrepreneurial experience as possible.
Yeah, well, the storytelling aspect too, we talked about at the top of our call, the value of storytelling, especially in this market. I think you understand the things that VCs pick up on, right? And now it's a meme. Oh, you've got to have a really big TAM, and everybody shows up with a big circle that has $3 billion at the center of it because that's how you get funded. But when you actually sit across the other end of the table, or even just go through 100 VC pitches, you start to key in on what do they care about, right? What are their incentives? They have to return money to their LPs. What do they need to see in my company to convince them that they'll actually get there? And so I think for those of our listeners that are fundraising right now, that's a good place to spend some time. Maybe speak to some friendly VCs, understand what their incentives are before you go out and sort of really pitch a story that you think should resonate, but ultimately, misses the mark in terms of what the other side of the table cares about.
I think so. I think that's a really smart idea. There is a danger to what I'm saying, what you're saying, which is that you can know too much, as a VC, and almost there's a benefit to some naivety from founders that, ultimately you've got to believe in the impossible. And so you can become too cynical as a venture investor and say it's never going to work. So there is a benefit to some naivety. But no, I think largely like being really smart about what your market is, the reality, the harsh reality of how competitive it is or how early or late you are. I think that reality is really, really helpful for founders. So yeah, having those conversations with VCs that are early and sort of testing your ideas out, I think is really useful.
Well, Tommy, we like to do a segment on the show called Hyper Hopeful. I know I previewed for you earlier, so I'm going to make a statement. We're going to see if it's hyper hopeful, and then we'll unpack it. But think of it like a rapid fire 1 to 2 minute answers. So let's dive in. So the wave of direct-to-consumer disruption that is targeting underserved communities and specific demographics, you've talked about this idea of focusing on big problems, right? Health and inequality. Is this hype? Or is this something that we should be hopeful about seeing change in the near term?
I think the hopeful bit is the idea of technology going after problems that really genuinely matters and makes people's lives much better. We've had a whole generation, I think, of companies who are making life marginally better for people who are already pretty affluent. And then a whole generation of big tech companies doing things like social media, which you could argue are probably a net bad for society overall. So I think we will see a new wave who are serving underserved communities, who are making the world a better place. The hype bit, though, I do worry about some of the direct-to-consumer stuff in that space, whether it's neobanks for a very specific demographic. I just worry about the unit economics of those businesses and of direct-to-consumer as a whole. So Yes to the underserved communities. Yes to tech being solving a problem that really matters for society. Less so, I think, on the direct-to-consumer side.
I like that. So here I'm sitting in New York. You're sitting in London. But Silicon Valley still considered the world leader in climate innovation. So given the growth of global tech ecosystems, global scale of the climate problem, should we still believe that Silicon Valley is going to be the epicenter of the climate innovation trend? Is that hype or hopeful?
I think particularly in climate, I think it's hype. Because we need to touch the physical real world, because we have to partner with incumbents, there is absolutely no reason why you need to build a climate technology company in Silicon Valley for it to succeed. We've had, for example, one company in the Nordics called Vargas, a holding company, which has produced already 3 climate unicorns with Northvolt, Polarium, and HG Green Steel. They're thousands of miles away from Silicon Valley, and they have the might of a big holding company to do it. They just don't need that kind of Silicon Valley ecosystem. So I think particularly within climate tech, there is absolutely no reason for that to be limited to Silicon Valley. I think Silicon Valley will continue to have an edge in things like SaaS, but climate will come from New York. It will come from the UK, Germany, all over.
I think COVID changed that a little bit too, right? Because you had to be in person, you had to fly out to the Bay and fight through SFO traffic to go pitch a VC. And I think since 2020, I've certainly gotten more comfortable making an investment in a founder that I've only met over Zoom. Look, nothing beats spending time with them in person, but I think certainly to your point, like some of those barriers have almost just naturally gone away.
For sure. I think COVID collapsed geography for venture forever.
Yeah. So the last one of our hyper hopeful, and I know you have some thoughts on this, so we can go as long as you want on it. A lot of experts have said that without the addition of nuclear energy, just transitioning to renewables will not be enough to achieve net zero targets. And yet VCs have not invested in nuclear energy, nor have there really been meaningful venture scale nuclear companies. So nuclear as a venture backable category within climate tech, is that hype or hopeful?
I think it's hopeful, but it's a very specific type of hope that we've got. I think there is a whole category of hard climate tech, which is venture backable, but at very, very large scale. So I just mentioned Vargas and what they've been doing with Northvolt, for example, and they're just now launching a heat pump version of the latest one of their incubations to come out of a conveyor belt. But we're talking about incubations which require hundreds of millions or billions of dollars of capital. And I think that is a very interesting model for climate incubation in Europe and the US, where you're going to get very large holding companies or corporates or both, who are going to say, we're going to go solve a very hard problem, whether it's green steel, whether it's nuclear, and we have the ability to bet $1 billion on that space. And it has the dynamics of a startup. It's a new team with a very, very small group of people that can create something special. And I think that will always be the way that it does. It's very hard to do something with more than a group of 10 people at its core that creates something from nothing, but they just happen to have billions of dollars of capital. What we're not going to see is, I don't think we're going to see nuclear completely transformed with a company that's raised $3 million in seed and then $10 million in Series A and $50 million in Series B. It's simply too capital intensive to achieve that. You might have some innovation around the edges, but the big, bold plays are going to require billions of dollars of capital that are not going to come from the traditional venture funds. But that's not to say that large venture bets can't have an impact on this space. And I'm completely with you that, nuclear is a massive part of the solution set here that we do need to get serious about backing.
Yeah. Well, I think about it a lot too, because I think nuclear fundamentally has a PR problem. And that's something that we obviously spend a lot of time thinking about at VSE Ventures, right? Industries that really need help with their storytelling and have very smart founders working on it. But, whether it's YIMBYism or it's government action or something, it's something we all know we need. And yet, how do you actually present it as a viable alternative to solar and wind and some of the things that maybe have done a better PR job? But I'm certainly optimistic right there with you, Tommy. I think I'm starting to see hybrid funds, ones that have, debt arms attached with their equity, and they back equity in a certain, holding company structure, but the debt that actually finances the infrastructure. There's ways to get around this, and I'm long-term hopeful with you there on that as well. So last couple of questions. You've been so generous with your time. There's one that I always want to get the perspective of early stage investors on, which is, encouraging more entrepreneurs to focus on these companies saving the world, these big audacious problems, not incremental things. What incentives or shifts need to happen to really push more founders to focus on climate tech? especially first-time founders that could be doing something else to be working on climate here? How would you motivate the founders you speak to go work on this problem?
I would say have a child, and that will change everything. Your child was just departing for their walk before we started shooting this podcast. But in my experience, it's been so powerful looking into the eyes of your newly born baby and just being really relieved that you're working on something meaningful, that you can be proud of telling them when they grow up that, you were trying to do something to really be part of solving climate change or making people healthier and solving inequality. And that, I think, is a theme we're seeing again and again, actually, of entrepreneurs who might have built a SaaS company or a consumer company the first go around and probably made a big success of it, and then choosing to build in climate for their second company, really because they want to do something meaningful with their life. They probably had a child and they want to, be part of the solution of something good. And that is a very, very powerful driver in my experience. So difficult to do if you're a 21-year-old founder, as you mentioned, coming out and starting. You probably don't have a kid yet. But actually, we see the same thing. We see a new generation emerging who are not messing around on climate. They're not taking any prisoners. They are very, very disappointed with the older generations and what the older generations have done to the world. And they are laser focused on working on things with meaning and purpose. And that trend, I think, is going to grow and grow and grow. And what we're seeing, I think, is the brightest and the best founders are increasingly choosing to build in climate or health or inequality. And also the best people want to go work for those founders. They want to go work with something which has a real mission. And I think that makes our job so much easier and so much more wonderful, which is, you're seeing incredible people working on the most audacious challenges to fundamentally use technology to make the world a better place, and feel very, very fortunate to be backing those people with Giant.
Yeah. A follow-up to that, given that, some of these folks, let's say they're in their 20s, they're coming out of university, maybe their first or second job. Fundamentally, at the early stage, founder market fit is so important, right? You want to back founders that have unique insight on a company or category. Does that matter in climate? Do these entrepreneurs need to have deep expertise in industry before they go after it? Or are there ways that they can sort of bring their enthusiasm and map it to an industry maybe that they haven't worked in before?
That is a really interesting question. I think quite a lot of climate tech, it really does help to understand the specific sub-vertical or industry that you're working in at a deep level. I think there is real benefit to that. So, for example, I mentioned Waterplan earlier, the water resilient SaaS company. They're a team of former entrepreneurs who've had an exit and understand how to build a company, but part of the founding team is a kind of global water expert. And both the credibility that brings, but also the genuine understanding of what type of business to build is very, very powerful. So I do think there is value to really actually genuinely understanding the theme you're going after. I think there are some types of businesses where it's less relevant, right? Maybe it's a marketplace model, which is less about detailed scientific breakthroughs or, really technical stuff. So there's always a route for people to play in this space. But I think there is an element of specialism within climate, which is pretty important.
Always the optimist, Tommy. I like that on a Thursday morning, Thursday afternoon for you. You've been so generous with your time. I'll close with the question we ask every one of our guests. There's a lot of doom and gloom out there. There's a lot of climate inaction out there. We read the news every day. And sometimes it's hard to fight off the climate anxiety. So what is maybe one thing that gives you hope or optimism about this fight against climate change? And where do you draw that positivity from?
I'll give you two things. The first is that, we probably only need 12 or 15 technologies to work to really go and solve climate. And a few of them, I think we've already got going. We've got electric vehicles, that's going to work. We're going to replace all the cars in the world with electric vehicles. We've got large scale renewables, whether it's solar or wind, are now powering so much of our electricity, and that will inevitably grow and grow and the cost will go down. So we've done it with a couple of these technologies. We've just got to go do the rest. And I believe we will. And that's linked to the second thing that makes me really positive, which is just what I mentioned about the best entrepreneurs are coming and solving climate. And if they do that, I believe very, very strongly that it'll be entrepreneurs who go solve the climate crisis, not governments, not corporates. Don't worry that the politicians are being a bit slow, because it will be innovation that carries us there and will push everyone with us. And he's a controversial figure, but you just have to look at what one person, Elon Musk, has done in the electric vehicle ecosystem. And if we can replicate that all over the economy, I think we will get there eventually to net zero, and we will solve this problem once and for all.
Tommy, that is the shot in the arm I needed this morning, man. Thank you so much for sharing your perspectives. I have learned a ton. If we have any smart, resilient, talent magnet founders that are listening to this episode, where can they find you?
Absolutely. Well, it's been such fun, such a nice way to end my Thursday. So thank you. They can reach out to me on LinkedIn, Tommy Stadlen. Just come and find me on LinkedIn, and would love to meet interesting entrepreneurs working on problems that really matter, and excited to team up more with you as well. And as I mentioned, we're big fans of the fund. Such a pleasure to be on the show. So thanks so much for having me.
Well, that's all for this week's episode of Climb by VSC. Thank you so much for watching and listening. Special thanks to Credo for their help in producing and promoting this episode. To visit any part of today's conversation again, you can find the full transcript on vscventures.com. Our thanks to Josue Ramiro for posting these every week. Lastly, if you've listened this far, please leave us a rating on Spotify or review on iTunes. It only takes a few seconds, really helps us out, and as far as I know, it's still carbon neutral. Well, that's all for now. We'll see you all next week on Climb by VSC.